let us talk about a very important asset management ratio, inventory turnover ratio. The inventory turnover ratio is the average number of times a firm sells and replaces a batch of inventory during a year. If a firm buys the inventory at one point of time, then it goes through a production process or stocking process, marketing, selling and all this process, and after that it is sold. So buying and selling, if we consider it as a cycle, then this cycle will continue throughout the year. We have 12 months in a year, January, February, okay, and until December. Let's say that our year starts in January and it continues until December, last day of December. If we assume that a company buy the inventory at the beginning of January, and it goes through production process, stocking process, selling process, marketing process, and it takes until the end of the December to complete all the process and sell the inventory, then we will say that the company turns over the inventory only once in a year. Okay, but what will happen if another company actually do the process twice in a year? Okay, complete the process twice in a year, then we will say that the company has 2 as inventory turnover. Similarly, if a company completes it in 3 months, there will be 4 inventory turnover in a year. So this is the main concept of inventory turnover ratio. Now we will see how to calculate the inventory turnover ratio from the information available in the financial statements. The inventory turnover ratio can be defined as the ratio of sales and inventories. So if you divide sales by inventories, then you will get the inventory turnover ratio. The idea is sales provides the figure of the whole year, total sales of inventory in a year, but the inventories comes from the balance sheet, which is the balance of the last day of the year. So it indicates kind of daily level of inventory or average level of inventory, if we assume like that. If you divide the total figure by a daily figure, then you will get the turnover. That is the idea. Now sometimes we need to adjust this because you know that on the last day of the year, the balance of the inventory may not represent the average balance of inventory throughout the year. So we can actually restate the formula as sales divided by average inventory. How to calculate the average inventory? That is very easy. You can take the beginning balance of the inventory of the year and add it with the ending balance of the inventory of the year, then divide it by 2. So that will give you the average inventory. However, this adjustment may not be sufficient because you know that some companies have seasonality in their business. So to take into account the fact of seasonality, we may take several observations during the year. For example, we can take monthly balance of inventory. Somehow we can collect it and then add all the monthly balance of inventory and then divide by 12. That is one way. Another way is to find the quarterly inventories from the quarterly financial statements, and then after adding that you can divide by 4 to get the average level of inventory. So it depends on the nature of the business organization whether you need further adjustment or not. In some cases, the analysts use cost of goods sold instead of sales. So the idea is because the sales price is usually higher and cost of goods sold usually represent the actual value of the inventory. So if you think like that, then you can take the cost of goods sold from the income statement and divide it by the average level of inventory. Now we will discuss how to interpret the inventory turnover ratio or what the inventory turnover ratio indicates. Let us go back to the basic formula. Okay, this is sales divided by average inventory. So we have to see how this ratio can help us to make decision or help us to conclude about the performance of a company. So if we want to do that, actually we have to know whether the inventory turnover ratio is higher or it is lower. Okay, if we want to conclude about that, then we need to compare with something, some kind of standard. So that standard is ideally the similar companies within the same industry, or it can be the some kind of industry benchmark like average inventory turnover ratio of the industry. So if you want to find whether the inventory turnover ratio is really higher or lower than what it should be, then you have to compare it with an appropriate benchmark or with that of the similar companies. Now, if we find that the inventory turnover ratio is higher than what it should be, then it indicates that the sales is high. Okay, because in this ratio will only be higher if the numerator is higher or the denominator is lower. So if the denominator is lower, then the ratio is going to be higher, and also if the numerator is higher, the ratio is going to be higher, which indicates that higher inventory turnover ratio means the sales is high, which is good. Every company wants to have their sales high. And if it is due to the maintenance of low level of inventory, again we can say that the company is able to support its sales by maintaining a lower level of inventories, which means lesser amount of holding costs, okay, and less engagement of cash with the inventory. So higher inventory turnover ratio is good, but if it is too high, then we have to have a very careful look at the level of inventory, whether the company is taking too much risk or not. Okay, if the inventory is too low, it may happen that the company may lose its customer because of stock out. So in that case, if it is too high, then we have to have another look why it is too high, and we have to take measure if necessary. Now, what if the inventory turnover ratio is lower than the standard? Probably the numerator sales is lower, or probably the denominator average inventory is higher, or both. Let us look at this. We don't want to have a low sales, definitely. So lower inventory turnover ratio indicates that you have to look at the level of sales, whether it is lower compared to the expectation or not. And also you have to look if the inventory level is quite high. Okay, maintaining a high level of inventory is not so good because it needs storage cost, it needs holding cost, and so on, carrying cost, whatever term you use, but it needs cost. So maintaining high level of inventory is not good. So you have to have a careful look. You have to do further analysis whether the company should reduce the level of inventory or not, whether the company should look into its purchase pattern of the inventory or not. That's all for now. Thank you very much.